Happy Friday, everyone. Thanks for joining us today on this edition of Business Daily. I'm Lee Ji-eun in Seoul. We have a lot of stories lined up for you today, so let's get started with a look at the day's highlights. Samsung expects to suffer losses of some $3 billion in profit over the next two fiscal quarters as it continues to deal with its Note 7 debacle. In the midst of protracted low growth, one economist suggests that Korea and other countries gradually raise rates to boost economic growth. These stories and more coming right up. The world's largest smartphone maker is about to suffer billions of dollars in losses from discontinuing the Galaxy Note 7. Now, that's the prediction from Samsung Electronics, commenting on its potential future losses for the very first time after revising down its earnings estimate for the third quarter. Our Kim Min-ji starts us off.
Ditching the ill-fated Galaxy Note 7 is expected to cost Samsung Electronics another $3 billion over the next 2 quarters. In a statement, the tech giant says it expects the termination to cut fourth quarter earnings by about $2 billion and another $1 billion in the first quarter of next year. Samsung also recently revised down its earnings estimate for the third quarter to reflect the losses. The company expects an operating profit of roughly $4.6 billion for the July to September period. That's down from the estimate of $6.9 billion released last week. Based on the new estimate, Samsung's operating profit is down about 30% from a year ago and the lowest since the third quarter of 2014. The wiping off of over $2 billion comes from the cost of recall as well as refunds and replacement, stock clearance, and marketing. Taking all that into consideration, the world's largest smartphone maker is expected to incur a total loss of roughly $7 billion.
The majority of the users will want a refund rather than replace with a S7 or S7 Edge because they originally wanted a large device with the pen function. So there's no substitute in the market at this point. So they'll probably go for a refund, and that will cost Samsung.
Earlier in the week, Samsung said it will end production of the Note 7, in effect announcing it will discontinue its flagship phablet less than 2 months after its launch. The decision came after reports of at least 9 replacement handsets catching fire, with incidents occurring mainly in the United States. Samsung says it'll try to make up for the loss by expanding sales of its flagship Galaxy S7 and S7 Edge models. It'll also use this as an opportunity to focus on enhancing product safety through changes in its quality assurance procedures. Kim Min-ji, Business Daily.
And moving on to markets, to give us a wrap-up of this week's stock market action, we have our Business Daily's markets contributor, Choi Jin-seok, joining us on the phone today. Hello, Jin-seok.
Thanks for having me.
All right, so as we close the week, how was the last day of trading?
On Friday, the Kospi rose by 0.36% to close at 2022.66, and the Kosdaq followed with a 0.2% uptick. The Kospi market was able to recover the 2020 mark, helped by both foreigners and institutional investors who bought shares during the session. However, institutions changed their position to sell at the end of the session, though. Stabilization in the foreign exchange market was a positive catalyst in lifting sentiment among investors. The value of U.S. dollar that has been rising due to expectations of an imminent interest rate hike in the U.S. failed to continue its upward trend, and that's why we saw currencies most emerging economies go up during today's session.
And despite today's rise, the Korean equity market had performed relatively weak throughout the week. So how was the overall market performance this week?
Exactly. On a weekly basis, the Korean stock market failed to stay in positive territory despite today's rebound. Through Thursday, the Kospi and the Kosdaq both plummeted by 1.9%. Strong dollar trends followed by the massive unloading of shares by foreign investors spooked market sentiment. By sectors, technology performed relatively weak as foreigners sold off their shares.
Now, as we expect the FX market to be an important factor for the coming week, what other upcoming market events should investors be looking forward to?
Experts say there are 3 factors that have been causing an appreciation in the U.S. dollar. First, better than expected wage growth data in the U.S. supported expectations for a December rate hike. Second, the value of the British pound and the euro have been falling sharply these days. Lastly, weak economic indicators from emerging markets, including China, have led to the depreciation of currencies in those countries. That's why investors are expected to pay close attention to the FX market going forward. Over in the U.S., Fed Chair Janet Yellen will deliver a speech early tomorrow morning Korea time, and Vice Chair Fisher will speak on Tuesday as well. The Q3 U.S. earnings season will be in full swing from next week, too. This has been Trending Up for Business Daily.
The Bank of Korea kept its key rate steady yesterday, but expectations mount over more rate cuts down the road, especially in the face of the Samsung Note 7 fiasco and a string of labor union strikes challenging growth. But some experts are calling for a fundamentally different approach. Take a look.
Weak investment, stagnant productivity, and lukewarm business and household confidence. These elements that characterize the trend of low growth continue to weigh down governments and especially central banks, pushing them to pump more money into their economies. Korea's central bank is not a stranger to loose monetary policies. The key rate stands at a record low, and it's still under mounting pressure to dive even deeper. But Robert Barro, professor of economics at Harvard University, considered one of the founders of new classical macroeconomics, says the focus has to shift.
I think the Bank of Korea, along with other central banks, has made the nominal interest rate that they control too low, kind of artificially low. And it's a strange kind of policy that you haven't seen before the Great Recession period, 2008-9. So I think Korea, along with other central banks, should be moving toward raising nominal rates back toward a more normal range, maybe 3 to 4%. A gradual policy of doing that, pre-announced, would be the best way of doing it. And if the U.S. were to do that, it would be easier for South Korea to follow that. Maybe the Bank of Korea could take the lead instead of waiting for the bigger countries like the U.S. to take an appropriate action. So that would be more daring because it's a smaller economy taking the lead.
Exactly. Do you think that is feasible?
I think it could be feasible, but the details have to be thought out more carefully. I mean, I'm making a suggestion. Maybe you could not wait for the United States.
So would that mean Korea also does not have room for more fiscal stimulus? Barro says.
Fiscal discipline is still important. I mean, Korea has room to spend more money from the public sector, but if, to the extent that you do that, you want to focus on projects that are actually productive. So some infrastructure investments can be reasonable, and one can use fiscal capacity to fund that in terms of maybe borrowing to do certain kinds of projects. But one shouldn't do it for its own sake, and one shouldn't do it in terms of demand stimulus. I think you have to emphasize productivity.
Korea also faces longer-term issues like the aging population. What should the government do to raise its growth potential?
Well, flexibility in the labor market is important. So you don't want to have regulations that inhibit firms moving around labor in terms of hiring and firing, for example. Population growth, of course, is very low now in Korea, which is also a standard part of the growth process. Fertility rates are extremely low. I don't think that's necessarily a negative. Some people have argued that the government should be doing all kinds of things to counter the declining trend in fertility. There are a lot of things you can do to subsidize basically people having children in terms of making it easier to have child care services or educational services. And I don't think that that's a central part of a development strategy. And I think mostly fertility reflects choices that people make, particularly in the context of more women working full-time in the labor market, and I don't regard that as a negative. It's partly reflective of people just getting richer, better education.
All right. Thank you so much for your time, Professor.
Thank you.
It's Friday, and you know what that means. It's time for a look through some important global business stories from the week. And for that, we're now joined by our Ines Kim in the studio. Hello, Ines.
Hello.
So oil prices have been continuing their bounce up and down despite OPEC's latest agreement on a production cap, perhaps reflecting skepticism that this deal might not bear fruit and be realized. But certainly Saudi Arabia and the rest of OPEC are motivated.
Yeah, absolutely. And that incentive is, of course, low crude oil prices, which, it should be added, have bounced back to the $50 level after that Algiers meeting a couple weeks ago. So today, we'll examine the impact that low oil prices have had on the economy of Saudi Arabia over the past couple years as its state-run oil company Aramco prepares for an unprecedented IPO.
Saudi Arabia, Korea's sixth largest trade partner and the world's #1 oil exporting economy. It had enjoyed decades of plenty thanks to the black gold that funded more than 3/4 of Riyadh's lavish expenditures and investment projects. Today, it faces a very different reality. As crude oil prices settle to a new, much lower normal, Saudi Arabia's revenue derived from crude was slashed by 68% from 2011 levels, forcing the Saudi government to take a hard look at the basics of its economy. Since crude reinforced its sharp drop in 2014, Saudi Arabia's debt burden has soared, forcing the Middle East's top economy to make up for its huge budget deficit by selling domestic bonds for the first time since 2007. And in a stunning 180 from its standoff with rival Iran, in late September, OPEC's de facto leader greenlit an in-principle cut to the cartel's production that had been driving the global oil glut.
And we came up with a way forward that is to consider targeting 32.5 to 33 million barrel per day target, and we agreed on having a high-level technical committee of all OPEC members to study the mechanism of sharing the production at individual countries level from now till the 30th of November to be presented to the next meeting in Vienna.
As OPEC nations knock out specific targets leading to the November meeting, state-run Saudi Aramco this week announced plans to be ready to launch its unprecedented IPO by 2018, with a valuation that would dwarf any other IPOs of the past. The commitment to sell just 5% of the oil giant's stock could raise $100 to $150 billion. Liquidity Riyadh will need to install hundreds of reforms meant to transform its oil-based economy to one that is fueled by investments.
You know, this reminds me of China in some ways, as China is also trying to shift its core fundamentals. So how does the Saudi Aramco IPO fit into the bigger picture?
Sure, that's a great question. And so the money earned from the IPO will be put towards Saudi Arabia's sovereign wealth fund, which is called the Public Investment Fund. And you can say this is a crown jewel of the country's stated Vision 2030. You see there, the blueprint consists of 543 reforms to help diversify and privatize the Saudi economy. And among the details is an aimed six-fold boost in non-oil revenue and a 5% value-added tax to be rolled in 2018. These are designed to shift the economy to be more diversified and privatized so that it can also balance its state budget by 2020. Saudi Arabia's budget shortfall last year came to 16% of its GDP, and the IMF is expecting that figure to fall under the 10% range if all goes well by next year.
Clearly, there will be a lot of reorganization and work left to do before the 2018 IPO, but we're already seeing a shift in the way the Sovereign Wealth Fund is investing.
That's right. So we're hearing today that the private investment fund is getting ready to back what would be one of the world's largest tech investment funds with Japan's SoftBank Group. The joint project is set to manage as much as $100 billion, according to SoftBank, with Saudi's fund providing nearly half that sum over the next 5 years. This is a prime example of the country's sovereign wealth fund looking more outward for its growth over lending for domestic development projects as it did in the past. By making Aramco an industrial conglomerate and transferring ownership to the public investment fund, its assets are projected to exceed $2 trillion. And by the way, this new tech fund, it's set to be based in London.
On that note, let's head over to London, shall we? I mean, there are some interesting developments on the Brexit front, I hear, because the process has actually gone to court.
You're absolutely right. And, there's been a lot of passionate opposition and, of course, also questions as to the legality behind triggering Article 50 that, of course, begins those EU negotiations. And now it looks like Britain's top judges will be forced to rule on that question. The UK High Court heard from the plaintiffs on Thursday local time, and the government is set to make its case on Monday. The challenge brought forth by British citizens with the backing of some of UK's top constitutional lawyers asks whether UK Prime Minister Theresa May can exercise a power called the royal prerogative to make a historic decision such as Brexit without approval from the legislature. The May government is taking this case very seriously, and experts say if the case is passed on to the Supreme Court, which would be sometime in December, this could stand in the way of May triggering Article 50 in 6 months, as she had promised, and could extend the Brexit process by another year.
I don't think May saw this coming.
It's definitely a process that's unraveling as we go because it is so unprecedented.
Right. Brexit altogether, right? All right. Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. But we'll be back with more next week at the same time, same place for your Business Daily. So don't forget to tune in then. Thanks for watching and see you soon.